Today, we'll be doing a financial analysis of UPS versus FedEx by Jacqueline Lopez and Gloria Esquivel. Here are the topics we will cover, but most importantly, we will cover the cost of capital, cost of debt, and cost of equity. Who are the shareholders? UPS has 724 million shares outstanding, and the top 10 institutions own 29.2%. FedEx has 314 million shares outstanding, and the top 10 institutions own 41.6%. As you can see, the same institutions own both UPS and FedEx. Some of the examples are the Vanguard Group, State Street Global Advisors, BlackRock Institutional Trust Company, T. Rowe Price Associates, Wellington Management Company. Why do shareholders care about our cost of capital? Investors care about the cost of capital because they are concerned with the rate of return. They know if the company does well, investors will be compensated for their risk. Therefore, companies strive to reach an optimal debt ratio because it leads to a low cost of capital, which will maximize the value of the firm as well as the returns on investments for shareholders. The factors that affect the optimal debt ratio are the tax rates, coverage ratio, variance in operating income, default spreads, and various firm projects. What is our cost of debt financing? The pre-tax cost of debt can be found by adding the default spread to the risk-free rate. The U.S. 10-year T-bond rate states that the risk-free rate is 2% as of February 14, 2013. FedEx has a rating of BBB+, which gives a default spread value of 2.5%. When added to the 2% risk-free rate, it gives FedEx a pre-tax cost of 4.5%. UPS has a rating of A+, which gives a default spread value of 1.3%. When added to the 2% risk-free rate, it gives UPS a pre-tax cost of 3.3%. The cost of debt is calculated by multiplying the pre-tax rate by the difference in the effective tax rate by the total interest rate, and this is the after-tax cost of debt. What is our cost of equity financing? The cost of equity can be found by using the CAPM, which is the capital asset pricing model. This model shows the relationship between risk and the expected return on a company. If we add the risk-free rate to the beta multiplied by the market risk premium, we obtain the cost of equity. Beta for both companies was obtained using the regression function in Excel. Under a 5-year monthly regression, FedEx obtained a beta of 1.23, and UPS resulted in a beta of 0.83. Under a 2-year weekly regression, FedEx obtained a beta of 1.11, and UPS resulted in a beta of 0.95. FedEx cost of equity declines from the 5-year to the 2-year, and this is because their risk decrease. On the other hand, UPS cost of equity increases because their risk increases. What is our overall cost of capital? The cost of capital is the rate of return required to convince investors to put their money in a specific investment. Cost of capital is determined by the market. The cost of capital was obtained using the weighted average cost of capital, otherwise known as WACC. Cost of capital is the weighted average cost of equity, debt, and preferred stock. In this case, none of the companies had preferred stock. So, FedEx got a 8.41% cost of capital and UPS got a 11.5% cost of capital. Could we lower cost of capital by changing our capital structure? According to the analysis, both FedEx and UPS can decrease their cost of capital by increasing their debt to the optimal debt ratio. How would a financial restructuring affect the value of our company? Restructuring can be done by improving capitalization, debt composition, and/or changing ownership. If FedEx restructures its debt composition, the value of the firm will grow from $35,537 million to $38,242 million. UPS value will also increase from $92,575 million to $102,863 million. Would more debt create unnecessary risk? Well, both corporations have their debt ratios below the optimal debt ratio, so they have room to grow without creating too much unnecessary risk. What does the competition do? The chart below shows the competition as well as the sector and industry. If we analyze it, we can see that FedEx has a net profit margin of 3.94, while UPS has a net profit margin of negative 11.996. FedEx is slightly less profitable than the industry, but on the other hand, UPS seems to be running a deficit. Although when we look at the debt to equity ratio, it shows that both UPS and FedEx have low debt to equity ratio, meaning that they're not highly leveraged when compared to the industry and other competitors, which is pretty good. Is our stock price fairly valued? FedEx Corporation's December 30th, 2011 stock price was at $82.98, while UPS December 30th, 2011 stock price was at $70.99. If we compare these prices to the currents, we can see that FedEx is higher now at $105.78. So it's overvalued. UPS current stock price is at $84.12, which is higher than the December 30th price, but not much, but it's still overvalued. Although, if we compare both companies' PE ratios to that of the industry and other competitors, we can see that FedEx is slightly undervalued, while UPS is extremely overvalued with a PE ratio of 100.578. UPS PE ratio might not be a bad sign though. It just means that the investors might be expecting higher earnings growth in the future. So UPS overall is a good company to invest in because it has greater potential to grow according to the capital structure analysis, and because it has a higher PE ratio. Thank you so much for watching.